This just might be the best IPO in recent years. With recent IPOs of highly hyped companies like Uber, Lyft, and Beyond Meat, rocket companies might just be the one that has the most growth potential and undervalued at the time of IPO. In this video, we are going to look at what rocket companies does, how their IPO went, and what their future growth looks like. Before we begin, don't forget to like and subscribe to support the channel. Rocket Companies is the parent company of Quicken Loans and Rocket Mortgage, and other personal finance and consumer service brands. Dan Gilbert founded the company back in 1985 and has grown Quicken Loans to the biggest mortgage lender in the United States. It closed $145 billion in loans in 2019 alone. This made them $5.1 billion in revenue and $893.4 million in profit. So this is no small company. They are actually the biggest employer in the Detroit area with around 20,000 employees. Most people are attracted to Rocket Mortgage because they have such low fees compared to other banks and institutions. A record 59% of U.S. mortgages were issued by non-banks in 2019. This is because people found it more convenient to go elsewhere to get a mortgage. A majority of the mortgage process can be done online. This makes it super easy for people just to hop onto their computer and apply for a loan. The average loan closer per month for somebody working in the lending industry is 2.3 loans per month. Rocket Mortgage, on the other hand, closes an average of 8.3 loans per month per team member. So they are by far the fastest loan closure in the industry. They attribute this to their easy-to-use online platform and specific process in which the loan goes through to streamline the closure as much as possible. Basically, they made an assembly line for mortgage loans so they can crank out as many as possible. They have a huge market share as well. The biggest companies in the mortgage market make up around 17% of total market share, and Rocket Mortgage has 9% of that 17%, so they have a huge market share that they know how to hold on to. Their retention rate for people using them for other loans is around 63%. This is a huge number. People who use Rocket Mortgage love it and have a great experience using their services. Also, 75% of new customers using their mobile app are millennials and first-time home buyers, which they think is a huge growth segment. When people need a mortgage, the first place that comes up is Rocket Mortgage because they can do everything online or even through the mobile app. This makes it so easy for first-time home buyers to go through the complicated process of getting a mortgage. Rocket Companies has recently had their IPO, or initial public offering. This just means that it is the first time that the company is trading publicly, so anyone can go out and buy a piece of the company. This is no small company though. They could have stayed private and been perfectly fine. They do not need any additional funding for expansion. The reason behind the public offering, according to Dan Gilbert, is that they were having trouble holding on to good talent because public tech companies came in and offered their employees stock options that could have potential big payoffs. So they decided to do the same and became public. Dan Gilbert also sees Rocket Companies as more of a tech company than a mortgage lender. This is because they're able to develop new technologies in the loan industry. They are also looking for possible new acquisitions to help streamline and grow the company even further. So what happened on the first day of trading? Rocket Companies were aiming to start off selling 150 million shares, around $20 to $22 a share. This would have raised around $3 billion. However, they did not meet that and started with 100 million shares at $18 a share, raising $1.8 billion, valuing the company around $40 billion. On the first day of trading, the stock actually slumped to 17.5 and closed just 1% above the initial offering price. The second day of trading was better though, and the company's shares gained around 20% and ranged from around $23 to $25 throughout the day. They are also looking to introduce a dividend for the stock if the company continues to grow. With low mortgage rates and the Fed not looking to raise rates anytime soon, Rocket Mortgage has seen a huge increase in people using their services. Even as the economy has suffered during the coronavirus pandemic, Rocket Companies has continued to grow. They originated $72.3 billion in loans in the second quarter of 2020, up 40% from the first 3 months of the year, and more than double the amount during that period in 2019. Rocket financial numbers also prove that it is in a strong position to take advantage of current trends. In fact, the company's preliminary revenue estimates for the 3 months ending June 30th, 2020, indicate a midpoint value of $5.03 billion. This is 267% higher compared to the previous quarter and over 400% compared to the same quarter in 2019. However, in its IPO documents, the company warned that the COVID-19 crisis could dampen that trajectory. Home sales have slowed, and future growth is uncertain. The company wrote in its disclosures, if the COVID-19 pandemic leads to a prolonged economic downturn with sustained high unemployment rates, we anticipate that the real estate transactions will continue to decrease. Any such slowdown may decrease the number and volume of mortgages we originate. Rocket states that this particular increase is due to generally favorable market conditions and the low interest rates, which led to an increased demand for mortgages. Taking this into account, Rocket would obviously not continue to triple its revenue every quarter, but its revenue has been constantly growing since 2018. Also, Rocket Companies is also already profitable, which is a rare sight for IPO these days. However, there are some concerns with the rest of the company's financial numbers. Rocket Companies has $17.6 billion in liabilities and $21.3 billion in assets, including $2.2 billion in cash. This just means that the money they owe is almost the same as the money they have. As long as the company can stay profitable and continue to grow, this should outweigh some of these concerns. I believe with such low mortgage rates, people will continue to look for mortgages or are looking to refinance. Rocket Companies also knows how to handle a downturn, as they went through the 2008 housing crisis and came out okay. Rocket Companies seems like a solid company with good financials and growth potential. This is one company that I don't mind buying and holding as they continue to grow for a long time. Also, if they do decide to throw in a dividend, then it just makes it even better. And with that being said, thanks for watching and like and subscribe to see more.